Okay. I think the inflation numbers are going to be holding center stage. It's perhaps a little more than what the market was prepared for, going by some experts, but our poll definitely threw up this kind of an expectation. 6.2% is the current inflation expectation for the current quarter, the forecast from the Reserve Bank, and for the subsequent third quarter as well, they've increased it to 5.7 from the earlier 5.4, but Q4 is held unchanged. For the full year, there's a full 30 basis point increase in inflation expectation. That is the inflation forecast, 5.4%. That's, pretty much close to 5.5 and 6. So I think expectations of rate cut have definitely got to be pushed back. I think the biggest surprise comes in the Q1 for next year, which has been increased to 5.2. The earlier number was 4.5. So it's a 70 basis point increase. I think that's going to push back rate cut expectations even beyond April, May, June of next year. We have to probably push it to July if this is the expectation, unless the year ahead inflation expectations becomes much lower. It looks like clearly rate cut expectations have been pushed back. The other big announcement, of course, is that an additional CRR of 10% has to be maintained on incremental liquidity because of the liquidity increase due to the return of the 2,000 rupee notes, but that's a temporary affair and will be reviewed on September 8th. With those preliminaries, let me go over to our guests. First up, I think we have Upasna and Kaushik Das with us. We also have Rajiv from the head of the CIO debt from SBI Mutual Fund. In a bit, we will be joined by the SBI Managing Director, Mr. Setty, as well. Okay, first thoughts from you, Upasna. What have you made of the increase in the inflation forecasts?
Lata, here I think broadly, if I look at the policy, decisions have been broadly in sync with what we have been anticipating. Our revised estimates for inflation after the vegetable-led inflation has been 5.4%. So the headline number does look in line. But I think internally, if I was to look at the quarterly profiles, the 6.2% does have an upside risk. I think the near-term risk to this quarter is much higher. While the last quarter estimates, RBI has preferred to keep that unchanged. My sense is that will be revised downwards eventually. So internally, I think there is much more upside to the near term. Going beyond FY24, like you mentioned before, we are at 5% inflation. So clearly, I think higher for longer is what the governor did emphasize, maybe in the global context, but that also remains the key even domestically. We do not look at a possibility of a rate cutting cycle happening anytime this financial year. We will have to, again, evaluate the conditions going ahead into the next year. But at the moment, I think there's more upside risk to inflation in the absolute near term. Okay.
Our bankers have also joined us. Mr. Setty from the Managing Director from State Bank and Rajiv Anand from Axis Bank. To you, Mr. Setty, does this change anything at all? Repo rate hasn't changed, but there is clearly an upward bias to inflation. And then there is the additional CRR announcement, probably for a temporary period. Your key takeaways?
Yeah, good morning, Lata. Thanks for having me here. And I think on the policy rates, it is on the expected lines. Of course, the surprise is on incremental CRR. The only positive point is that it's going to be reviewed soon on the 8th September. So, but I don't think there's going to be a significant impact on the liquidity situation in the system. That is what my assessment is. And apart from the inflation trajectory which is projected, again, the good thing is that the Q3 onwards, the inflation as expected is projected less. That is going to be a positive. Apart from that, there are many other things governor has announced in terms of the measures. I think they're far-reaching impact. One is on the platform, the frictionless platform, what RBI has announced. Major banks like SBI are also working very seriously with RBI Innovation Hub, that what kind of products we can make it available on this platform. Similarly, the greater transparency on the interest rate of EMI, floating rate interest rates, is also a good step, because there was no uniformity in terms of resetting the EMI or tenure of the loans. I think this transparency, both in resetting as well as communicating to the customers, I think has been a very, very important step what RBI has announced now. These are my initial remarks.
Okay. Okay, sir, this 10% additional CRR you'll have to make will kind of lower your profit for only this quarter? July, August, September?
No, I think there
more
will
idle
be
money, no?
There will be some impact. We'll have to assess what is the NDTL increase during the period which is mentioned, and then we will have to assess what is the impact. Now we are just working on it. There would be a slight impact, but since 8th September is also mentioned there, I think the pain going to be lesser, I suppose. Hopefully the 8th September review will probably discontinue the incremental CRR.
That's right. Only the Nifty Bank is reacting at the moment to that announcement. The Nifty Bank has gone down considerably. I think it's a 0.8 fall that it has seen. Of course, it started on the back foot, but it's just gone up. The losses have increased. There hasn't been much of a movement in bond yields. We saw a brief 7.18 when the inflation numbers were announced. After that, the bond yields have come back to 7.16. So I don't think this is MTM losses on the bond book, but clearly a little more money taken away from the banks and told to keep idle. Basically, that's what CRR is. Taking away a small portion of the deposits and telling the banks, no, you can't lend. So up to September 8th, this disability is going to be suffered for at least a month and a little more. Rajiv, Anand, is it, a little bit of negative for the bank profits for the second quarter? Is that the only negative? No problem in terms of margin impact from the hawkishness of the governor?
This is a move basically to immunize the money that came in because of the 2,000 rupee action that RBI took. Our own rough and ready estimate is that the total impact to the banking system is about 1 lakh crores for this brief period. In the context of the fact that there is 2.5 lakh crores of surplus liquidity, I think the impact, whether it is on NIMs or on profits, is really minimal, because it's just for a period of a month. So I don't think the impact is going to be material at all. Secondly, I think the underlying growth, continues to be strong. Credit demand continues to be strong. I think what we have to work through is the continued, fight for deposits, and that really is going to be the theme for the rest of the year.
Okay, yeah, there will be that pressure, of course, on the cost of funds. Let me get to Rajiv, Radhakrishnan as well. Rajiv, the bond yields went up, but now they are back at 7.158 or thereabout, 7.16 to be precise. You think that this is going to leave the bond yields unchanged? Your key takeaways from the policy?
Yeah, so broadly, it's a long anticipated line. So when you look at the overall set of measures that the RBI could have done, addressing liquidity, I think probably was a path of least resistance. And even within that, it is largely a one-off move on an incremental basis. You've increased the CRR. So to that extent, I think from a bond market perspective, given that a hawkish commentary and a potential upward revision in CPI estimates were broadly factored in, I think that's the broader sense that you get at this point, that market has largely been, it's in line with the broader expectations that the market had getting into the policy. But I think what's more important is RBI has very clearly, conveyed its, intent to address the surplus liquidity in the system. So to the extent that the surplus liquidity conditions continue for some more time, one may need to be cautious about incremental actions to address that.
Exactly. I mean, I don't have the near-term yield with me, I only have the CCIL index where I'm not able to get near-term yields, but there would be a pressure, right? Near-term yields, T-bills yields should go up because the near-term liquidity could be a little tighter?
I should assume so. I mean, at least on an incremental basis in the near term, we should expect a marginal uptick at the shorter end. But what is more important is I would just reiterate that how the liquidity dynamics evolve going forward. And I think that's one segment that the RBI would be really focused on going forward.
Okay, so 7.17 now as I speak with you. That is, of course, the 10-year, but near term, the T-bill investments could take a bit of a hit because banks have slightly less loose cash. They have to keep aside a little more as idle CRR money. That's the basic message of the CRR rule that Reserve Bank has bought, but it is temporary. Remember, it's only going to hit Q2. Kaushik, I think the inflation forecasts are a bit of a nasty shock for you.
Yeah, I think RBI has kept a lot of buffer in their forecast rather than keeping on changing every policy like Governor Das mentioned. So I think they have now kept it on the higher side, and I think inflation now will surprise to the lower side compared to the forecast that they've given. So they've given 6.2 for July, September. As I told you before, my forecast is about 5.8. So I think by September you'll see a very sharp disinflation, and then the numbers will keep on surprising to the downside. And October, December also they have increased. I think there's a downside risk over there as well. The good positive part, if you have to take from here, is that they've kept the January, March 24 and April, June at 5.2, which means that even at 6.5% repo rate, your real interest rate is 130 basis points positive, which is the positive way to look at it, because monetary policy members will look at the medium-term inflation outlook, not just the month-on-month volatility, and decide on the policy front. So from that standpoint, you could argue that there's no need for further rate hike when you come to October, because by that time the disinflation process would be very much in place, unless you keep on getting repeated shocks, which is something which we don't know, and that's why RBI has kept the buffer. On liquidity, we were actually anticipating something, because for the last few weeks RBI was not doing VRRR and liquidity surplus was there in the system, so we were wondering maybe something could be there in the policy, and this has come as the incremental CRR. But remember that closer to the Diwali festival, you'll have currency circulation leakage, and then you have bunched up state elections in October, December. There could be further currency circulation leakage. So I think this measure, what has been announced, will be only used temporarily, and beyond that, RBI will probably not need to keep liquidity impounded, and you see natural tightness of liquidity coming back into the system, and they can do away with this measure that they've announced.
Okay, Mr. Setty, coming back to you on this incremental 10% CRR, if we could get a little more from you, because we already saw a margin compression from SBI in the quarter that you just reported. In the near term, because of some of this withdrawal of excess liquidity, do you expect margins for the bank to come under further pressure?
So I don't think so. See, as Rajiv mentioned, the impact is likely to be around just about 82 to 1 lakh crores for the system, and it could be even less for SBI. But more importantly, our ability to lend is not impaired, right? So I think we have sufficient cushion in terms of the excess SLR, and the liquidity availability to us is also significant, and our deposit growth rate continues to be in the double digit. So I think on the margins front, I don't really see significant impact. And even if there is, I think it's only a short-term impact. I don't think it's a really meaningful or significant.
And Mr. Setty, what happens to your lending rates from here on? We're looking at the CPI projection remaining above 4%, at least till the first quarter of the next year. The rate cut cycle is pushed back, at least until then, if not further. What happens to your lending rates?
So we'll have to see, what kind of emerging scenario is there. As far as, so far deposit rates, we kept reasonably market oriented. We haven't had any significant increase in the deposit rates. At the same time, as we keep saying, our deposit franchise is very strong, and we would like to compensate our depositors adequately. And that has been our philosophy. And on the lending rates, there could be a small uptick if CRR carry has to be added to the MCLR. But we'll have to see whether we're required to pass on to the consumers or not. That decision will be taken by the ALCO. Broadly, I think up to March 24, the rates, lending rates and deposit rates will continue to be what they are now. I don't see any significant movement there.
Okay. Mr. Setty, just to continue with, I thought Ritu put the finger on the right point. Would you, because there is a bit of liquidity tightness that the Reserve Bank is pointing to, the way they are behaving, would there be an upward pressure on deposits? And, even in this ability to pass on the cost of the extra CRR, do banks really have that elbow room? So again, margins question.
Yeah, no, that's what I was mentioning. That's what I was mentioning. The CRR carry may not be really significant in terms of pushing up the rates. And the deposit rates, I don't know about the system, but as far as our SBI is concerned, I think we are in a comfortable position. We have not been desperate to increase the rates of interest on the deposits, because of our excess SLR, what we keep mentioning, which provides us adequate liquidity to fund any credit growth which comes up. So that is the reason I was telling Ritu is that there may not be a real pressure on our margins.
Okay. Rajiv, similar question to you. As the banks get smaller, I guess the top 5 banks are in a slightly better position. But is there going to be more pressure on deposits? And probably they don't have an option, but may be forced to lend. Is there more pressure on the smaller banks in terms of margins?
If you look at incremental deposits, the top 5 banks now comprise almost 50-55% of the flows come to the top 5 banks. And so therefore, by definition, the rest of the banking system is really, fighting for the balance 45%. And what you're also seeing is that the top 5 banks are continuing to increase their branch presence across the country, and they continue to invest in digital capabilities. And so therefore, if the smaller banks want to compete with the larger banks on the deposit franchise, they will need much larger investments on both branches as well as digital capabilities. Now, whether their P&Ls, balance sheets are able to support that is really moot. But the fact remains that 55% of incremental deposits is coming to the top 5 banks.
Mr. Rajiv, Anand, before we go to the Economist again, what the RBI said on the EMIs, they want to make it more transparent, the interest rate resetting for, loans that are equated, monthly. I just wanted to understand, are you expecting some tweak here or just more transparency in terms of disclosure to the borrowers? Any impact at all from either the customer side or the bank side? Mr. Rajiv, Anand, if you can hear me.
Sorry, I didn't get that question.
On the EMI, what did you glean from what the governor said in terms of tinkering, getting more transparency in the interest rate resetting for EMIs? Will that mean some sort of changes or just more transparency in terms of disclosure to the customer? So the impact on banks as well as the borrower.
I think the focus really here is around transparency. And given the fact that almost the entire retail book particularly is now linked to external benchmarks, I think it's very important for retail customers to understand how those rates are going to change, when those rates are going to change, what is the impact on tenors, etc. So I think what RBI is pushing very hard on is to ensure that banks are being absolutely transparent on this, and we're completely supportive in terms of the actions that RBI is currently taking around this.
Okay. Well, just a final question to you, Mr. Setty, before we let you go. On this infrastructure development fund for NBFCs, it says you don't need a sponsor anymore and you can finance the toll operators as well. More importantly, they are allowed to raise money from ECBs. What's the net impact? More money available for infrastructure? Do you think this route will be deployed more?
Yeah, obviously, Lata, I think particularly on the toll operate transfer projects, most of these projects were completed projects, what we call TOT projects. So IDFs participating in that will enable many completed road projects to be refinanced. So there will be more funding available for the infra, and raising ECBs also would definitely diversify their funding resources and help in supporting the infrastructure spending in the country. I think these are a few, facilitators. Definitely would help them, expand their resources raising capacity.
No, let's.
Well, Upasna, before we wrap up, a quick word from you as well, since we're going to be hearing from the governor. Anything you'd like to ask him, any more clarity you'd seek from whatever we've heard from the governor so far? Yeah, Upasna, go ahead. So, Upasna, we were asking if, what would you like to hear from the governor? We're going to be in a press conference with him shortly. Any more clarity you'd seek from what we've heard from so far?
No, I think the governor has been quite adequately, clear in what they really want to provide as a forward guidance. They are going to be watchful on the inflation prints, but they will probably try to look through some of the seasonality, which is bringing an upside to the inflation scenario. So I think that part is very clear. It is more on the liquidity side. While the recent measure on CRR is a temporary measure, I think somewhere clarity on what is an optimal level of liquidity which the governor will be comfortable with, that is something which would help, because going ahead, like Kaushik did mention, the second half of the year does tend to see seasonal currency leakage. Secondly, the deposit accretion that has happened because of the 2,000 rupee note withdrawal, how much of that is permanent in nature? All of this will determine the conditions on liquidity going ahead into the second half of the year. And that may eventually result in a much tighter situation than what we are anticipating today. So while this is a temporary measure, probably some more clarity on the liquidity stance. That is something which I'd want probably more clarity on.
Okay. Fair point, actually, Upasna. I'm sure everybody will want to have much more clarity on the liquidity situation and how tight would the Reserve Bank want it to be, and what is even their definition of tightness. Well, those questions as well for our guests after the break. Let me thank the bankers for their time, Mr. Setty and Rajiv, but if I can request the economists and the bond dealers to stay on, we have a few more questions. Welcome back. The markets have kind of relaxed in terms of their reaction. The Nifty Bank has cut its losses. The CRR impact is expected to be temporary and marginal. And as Mr. Setty, the managing director of SBI, pointed out, maybe they could pass on a bit of the cost, if at all they have to. So Bank Nifty has come back a goodish bit. I think it's also come back because the bond yields have once again fallen, went up to 7.17, back at 7.16. So extremely ranged impact. We have been, Ritu Singh and I have been discussing the impact of the monetary policy and the key takeaways that experts have drawn. We still have with us the economist Kaushik Das and the CIO of SBI Mutual Fund, Rajiv Radhakrishnan. Well, final question to you, Kaushik, what would you want to know from the Reserve Bank governor?
So two things I would want to know. Why is this decision to do this incremental, CRR? They were doing VRRR. I think governor mentioned that the takeoff was not that great, but could you still not have continued through VRRR and not bring in this kind of ICRR and complicate issues and bringing in uncertainty? So more, a color on that. And the second question that I would, like to know from them is probably in the evening we'll get that data, inflation expectations of households, how they have behaved over the 3 months, 6 months, 12-month period, and how much concerned RBI is from an inflation expectations point of view. Can it kind of get unhinged and those kind of things? One good thing is that governor has talked about core inflation being lower by 100 basis points from its peak, and has kind of mentioned that core inflation is kind of not, kind of a concern at this moment. So if that happens, I think bond market will take comfort from the fact that if RBI is not hiked in August, when inflation is supposed to be this high, by the time you go to October, by September, inflation would be anyway coming off. And then you would at least not need any more rate actions, and you wait till the next financial year. I told you last policy that the rate cuts probably will start from April of next year. And we still hold on to that view that any rate cuts will start from April of next year.
Okay, still possible in April? Okay, it's certainly not till April. Thank you very much, Kaushik Das, for staying with us through the monetary policy. Rajiv Radhakrishnan, final thoughts in terms of takeaways, impact on the bond market, and what are the unanswered questions?
I think the main unanswered question would be, what is the RBI's tolerance band for surplus liquidity? So, even as it stands, remains that, accommodation needs to be withdrawn. From a market perspective, some framework that sort of defines RBI's tolerance level for surplus liquidity, maybe on the basis of NDTL. I think we used to do that in the past. So something like that probably would be the key question that we would probably need to get from the RBI in the media briefing subsequently.
All right. Okay, we will get to know from the governor whether he chooses and what he chooses to say, especially with respect to liquidity. A lot of questions. They have chosen to withdraw some liquidity through CRR increase, and that may bother the bond markets as to, what will be their future course of action. Will they not hike rates but keep the pressure on by tightening liquidity? That seems to be the uppermost question. We will get more nuances from the Reserve Bank governor when he addresses the press at 12 o'clock. Thank you very much for being with me and Ritu in this monetary policy coverage. We'll go into a break and then we will go back to our stock market analysis on trading hour.